Okay, so this is chapter 3, and in this chapter we're focusing on cost behavior. So we're continuing on looking at what we covered last chapter when we talked about variable cost and fixed costs, and now we're going to add mixed cost. So what we're really trying to do is look at how cost changes in response to volume changes. So with variable cost, when the volume goes up, the total cost will go up, but the per unit cost remains unchanged. When the volume goes down, the per unit cost remains the same, but the total variable cost will be reduced. So you'll hear the term relevant range. So fixed costs do not change over the relevant range. So the relevant range, we're talking about the normal operating range of activity. So for instance, if you're a plant that's manufacturing lawn chairs, and if you run your factory 7 days a week, 24 hours a day, and it's producing at maximum capacity, so that's a relevant range. So over that time period, maybe you can produce 10,000 chairs a month. So the relevant range is fixed cost per unit. The total fixed cost won't change up to making the 10,000 chairs. However, if you need to make more than 10,000 chairs, then your fixed cost will change because you're going to have to extend your plant, put an extension on your building or move to a new building, but your fixed cost would then have to go up. So the relevant range is your normal operating range of activity. So fixed costs, so some more examples of fixed costs would be your property taxes, insurance, depreciation, maintenance. So if you're running a hotel, maintaining your parking ramp, the hotel furnishings, room furnishings, the pool, making sure you have the cable, TV, and wireless internet access for all rooms, the salaries of the managers of the different departments, and various committed and discretionary fixed costs. So unlike variable cost, what happens here when you increase your volume within the relevant range, the cost per unit actually will decline. Whereas if you decrease your volume, the cost per unit will increase because you're spreading your fixed cost out over fewer units. So some costs are mixed. So mixed costs increase as volume increases. So mixed costs contain both variable and fixed components. So think about a hotel. We'll look at our example here, Banff Rocky Mountain Resort. Look at the utilities for that resort. So they are mixed because just to maintain basic operations, they're going to require a basic level of utilities. Whereas there's a variable component, which is the more guests you have at the hotel, the more water, the more electricity, the more gas will be required. So here, for those types of costs, those utility costs, they have both fixed and variable components. So we're going to look at an example, a fitness center. So the fitness center has fixed operating costs of, say, $10,000 per month. The variable costs are $1 per member. And your relevant range, so the facilities can serve up to 750 members per month. So that's the maximum membership. So in order to look at this situation, what you're going to do here is you're going to look at your cost at different membership levels. So if you have 100 members, it's $1 per member, so $100 variable cost. Your fixed cost is $10,000, regardless if you have 100 members, 500, or 750 members. So your total operating cost would be, for example, for 100 members, would be 10,100, and for 750 members, 10,750. Your variable cost per member, as we noted above, is $1. Your fixed cost per member, the total fixed cost is $10,000, so that doesn't change. But if you are assigning the fixed cost to the membership, the higher the number of memberships, the lower the cost, fixed cost per member. So it looks like it's not profitable, you know, at 100 members, where the average cost is coming out at $101, whereas 750 members, it's $14.33. So that's really not giving you an accurate portrayal of the actual cost structure, because your fixed costs remain fixed. It's the variable costs you need to be concerned with. So this is presenting a bit of a distorted view of your cost structure. So there's 3 ways to analyze cost behavior. We have scatter plots, which I'll show in my next PowerPoint. The high-low method and the regression analysis method, both of those are demonstrated in my YouTube videos, which is in this the file folder for this chapter. So when you see the videos there, you will be able to understand these 2 methods. So with if you're just plotting your volume across the bottom, and then up the side is the cost. So it pretty much runs a straight line. So if you can take your ruler and run a line that goes through pretty much the center of all of these points, that tells you there is a relationship between the cost and the volume. There's one outlier which you would ignore. So if these plots, if this scatter plot had, you know, was all over the graph, it would show that no, there's no relationship. But here, there is a relationship between the utilities costs and the number of guests that stay at the hotel. So now we're going to look at ways of presenting your income. So the traditional way is to look at sales revenue less your cost of goods sold, giving you gross profit, then deduct your operating expenses to come out with operating income of $10,600. So that's the more traditional way of presenting your cost. So the product cost in here is comprised of the materials, labor, and overhead. And their period cost are the operating cost. A better way to look at your income statement is to organize it by behavior. So here what you do is you take your sales revenue, less your variable expenses. This will give you contribution margin. And then you deduct your fixed expenses to arrive at your operating income of $10,600. So the bottom line is still $10,600, but what this format, this contribution margin income statement format is doing, it's telling you how much of a contribution margin you're making over and above your fixed expenses. So here you can see you've got a fairly healthy margin. You've got 21,000 contribution margin, less your fixed expenses of 11,000. So if you're just breaking even, you'd have a contribution margin of 11,000. So the idea here is you want to you want your contribution margin to be higher than your fixed expenses. So variable costing, as we've mentioned before, that assigns only the variable manufacturing cost to the products. And so your variable expenses would be your direct material, your direct labor, and your variable overhead. Then your fixed manufacturing overhead is treated as a period cost. So to just go back for a moment. So the contribution margin income statement, that format is just used internally. You don't use that format for external reporting, but it's used for internal management information. Absorption costing, here is what is required for external financial reporting, whether you're looking at accounting standards for private enterprises or international financial reporting standards. So with absorption costing, all manufacturing costs, both variable and fixed overheads, are absorbed or factored in to the cost of the product. So all products include all inventoriable cost. So when you're looking at these, the absorption costing, this would be your traditional income statement. So that's the first one that I demonstrated here a few slides back. Okay, so another way to present your income statement for internal management purposes is to do it by segment. So if you were running an equestrian center, you might be boarding your horses, you could be providing horse riding lessons, etc. So here it's helpful for the organization to break down its income and its expenses along their major segments of their business. They need to know how much they're making from boarding horses versus how much they're making by offering horseback riding lessons. So for each of the segments of the business, you have your sales less your variable cost, and then you come down to contribution margin. Then you're going to identify those fixed costs that can be traced to each of the segments. So the fixed costs that can be traced to boarding and the fixed costs that can be traced to the lessons. So that will give you your segment margin. So that tells you how much each of these segments is contributing to the overall profitability of the company. And then you've got your common cost. So those common costs are, it's $167,000. So those costs, they can't be attributed to either the boarding or the lessons. These are common costs that are needed to run the organization. But what this does, it shows that the boarding is giving you $52,000, whereas the lessons, you're making a lot more money on the lessons, $156,000. So if you just had the total column, this is not giving you nearly as much information as you're getting by breaking it down into segments. So that concludes the major topics for this chapter. And again, make sure you review my YouTube videos where I demonstrate how to solve the problems in this chapter, and do your quick check PowerPoints. And as usual, do the problems at the end of the chapter, those that are listed in your syllabus, and check your answers. So that concludes chapter 3.